Hello everybody, my name is Ryan Hughes and I'm Head of Active Portfolios here at AJ Bell. The last couple of months have seen Neil Woodford be firmly in the headlines with a whole raft of problems with his fund that's resulted in the fund suspending. As we're a couple of months into this, I thought it'd be interesting to spend a little bit of time just looking at some of the problems that have sat behind the suspension of the Woodford Fund, and also think about some of the analysis that we've done into the fund and how we think about fund selection to give a little bit of an insight into the type of thinking that can be done, and also perhaps to help you with your own investment framework as well. This should take about 20 minutes. And if you have any questions on any of the content, then please do feel free to email into your usual AJ Bell contacts and we'll be delighted to get back to you. So just as a brief recap, I'm sure absolutely everyone knows the issues. Very well done to you if you're not aware of all the issues going on with Neil Woodford. It's been the only story in town for the last couple of months. But in simple terms, of course, we've got a mismatch between the liquidity of the fund and the desire for investors to get their money back when they wanted it. And of course, as a daily dealing fund, the notion is that you should be able to get your money back when you want. And the problem has been really because the market has been very quick to smell the blood of the issues that were going on in the Woodford portfolio. That is a portfolio that was focused on smaller companies and illiquid companies, and also then a mismatch as investors wanted to get their money back. Now, of course, the market and participants in the market, particularly those in hedge funds, were very aware of what stocks Neil Woodford was owning in the portfolio, and very aware of that he was likely to be having to sell these stocks to fund these redemptions, and of course have then taken it upon themselves to short these stocks as they expected the stock price to fall, and that's been exactly the case. And of course that has exacerbated the issue as performance has got worse and then more people want to sell. So the market has actually in many respects acted very rationally in this. There has known that Woodford's been under pressure with the shorting. And one of the interesting things, actually, when you think about the Woodford portfolio, is that he's always been very transparent about what was held in the portfolio, publishing the full list of positions every single month, so everyone could see what was held. And while on the one hand he's been applauded for this transparency, I think it's very interesting now to reflect and think that actually that level of transparency has been to his detriment, as it's enabled the short sellers to really go after and attack some of his less liquid positions that they knew he was having to sell. So it might be very interesting going forward to think about how other managers focus on their transparency, particularly in the smaller company space, and maybe people will be more protective of the stocks in the portfolio going forward, which is obviously a shame, as investors in the fund quite rightly want to know where their money has been invested. So just taking a little bit of a more detailed look around the types of flow that came into the Woodford Fund over time. So this chart here is actually from the FCA and was from correspondence that was had with the Treasury Select Committee regarding this issue, with the blue line reflecting the assets under management of the fund, and the orange bars reflecting in part the monthly flow into the fund. And as we can see, for the first couple of years of the fund, flow was positive month on month, and assets grew. And actually, if we had a performance chart on here as well, we would see that performance of the fund was very strong for the first couple of years of its life. And then we have a flat period in the middle where flow kind of peters out through late 2016 and early 2017, and then we really kind of reach the tipping point where flow completely changes, and we move to a period of significant and sustained outflow, month after month of outflow, resulting in the manager having to sell his stocks time after time after time. And this kind of creates a self-fueling issue in the fund there. And then the crux of the matter came right at the beginning of June, with the very last bar there, which wasn't a 1 month flow, but was a 1 day outflow, where we saw a local government pension scheme want to get its money out in 1 day, and that was the point where the fund had to suspend because it couldn't meet those redemptions. And so it's a very interesting picture. A lot of this type of information is actually available if you have access to something like Morningstar or FE Analytics and packages such as that. You can actually plot this kind of information on the funds that you're reviewing. So there's no secrets going on here. This is just a type of analysis that we would do, looking at funds and looking at strategies to understand the pattern of flow that's existing. Now, what is interesting, I think, when you look at the Woodford Equity Income Fund, is just how the fund is very, very different to the Invesco High Income Fund that Neil Woodford was managing when he left Invesco. So on the left-hand side here, we've got the top 10 holdings from the Invesco High Income Fund in June 2013, and then on the right-hand side, the top 10 holdings from the Woodford Equity Income Fund at the end of April. Now, quite clearly, there is a distinct difference in the two portfolios. In fact, it's actually evident to say that the Woodford Equity Income Fund is a totally different fund to the Invesco High Income Fund, a clear shift in focus away from very large global businesses that are essentially very liquid towards a set of companies that is on the whole pretty small, a number of unquoted stocks there, and names that really are not traded internationally and actually will not be well known to most investors. So I think it's fair to say that the two funds are actually incomparable in their nature. But of course, the problem we see is, in essence, investors bought the name above the door rather than what the fund itself. They bought Neil Woodford because he was Neil Woodford, and not because of what was going on in the fund. And there was, I think, in part an assumption that the Woodford Equity Income Fund would be managed in the same way as the Invesco High Income Fund. But actually, Neil Woodford was very clear when he launched Equity Income that there would be a greater focus on smaller companies and unquoteds. But I think it's probably surprised investors to the degree of that. Now, the bottom grids here is some Morningstar analysis that we've run, which shows the style and size positioning of the fund. So on the left-hand side, the kind of dark blue splodge that moves across there is how the fund has changed at Invesco over an 11-year period. And we can see that it's nearly always been large cap, and it's been pretty core in its position towards growth or value. When we look on the right-hand side and we analyse the Woodford Equity Income Fund over the last 3 years, it is distinctly different. So we have a very significant allocation to small cap equities. We have literally nothing in large cap equities, nothing at all in the very largest companies in the world, and actually, in essence, perhaps a slight tilt towards growth, and certainly no exposure to those classic value stocks. And in many respects, Neil Woodford made his name. So that analysis there shows you that the two funds are totally different in their approach, in their structure, in their makeup, and are incomparable when thinking about the two. Now, again, this information was available to people that have the Morningstar package. It's the type of analysis that we do on funds. We analyse over time to see if managers do change what they say they would do, and doing this kind of analysis would flush out exactly the investment approach that a manager is taking, and would have made clear to investors that the Woodford Equity Income Fund was totally different to the Invesco High Income Fund. So if we dig a little bit deeper into Woodford Equity Income and talk about liquidity, obviously liquidity is the main issue here, given the fund cannot meet its redemption requests. And here, again, we've just taken some data from the FCA, and they analysed the liquidity profile of the fund back in June last year, and then in April this year. And the way that the FCA analyses liquidity is to think about what percentage of the fund can be sold in certain periods of time. So bucket one, what percentage of the fund can be sold in a week? Bucket two, what percentage can be sold in a month? Bucket three, up to 6 months, and so on and so on. Now, interestingly, there a year ago, we can see that we had about a fifth of the fund that could be redeemed in a week, That wouldn't necessarily be unusual, even for relatively illiquid funds. And also, I mean, we have to remember that investors redeeming a fifth of a fund in just 1 week, it would be a highly unusual event. And so the liquidity profile of the fund back in June was perhaps not unusual, but I think it was still potentially showing some cause for concern, with over half of the fund not being able to be sold in less than a month there. So a couple of warning signals, I would say, if you were looking at liquidity a year ago. Now, as we move on to April of this year, a complete sea change really, in that liquidity bucket number 1 for the most liquid stocks has completely changed. We've gone down from 21% to 8%, and the percentage in the most illiquids has picked up materially. So there was a shift in liquidity in the fund, and again, this really comes back to a self-fueling problem. Where as investors sell from the fund, the manager is in essence forced to redeem the most liquid positions in the portfolio, which then makes the illiquid positions a larger part of the fund, and thus the fund becomes more and more illiquid as more and more investors sell the fund. As a result, it's very, very important when analysing funds to understand the positions of the fund, the makeup, the liquidity profile of the fund, how much of the fund is owned by the largest investors, to think through what would happen should 1 or 2 of those large investors decide to sell their holding in one go. All of these factors are things that should come as part of as an investment process. It's something that we have in our investment process here when analysing funds, and can really flush out, I think, quite a lot of important information around some of the risk factors that exist in a fund. Now, one of the other factors with Woodford, of course, I think, is that he was very, very comfortable taking large positions in companies. So not only is he illiquid, but he was also owning significant stakes of illiquid companies, certainly in some cases in excess of 20%, up to the maximum of 29.9% of a company. Now, that's all well and good when things are great, but of course when you need to sell some of that company, when you own so much of that company, in reality, there are very few buyers on the other side that are prepared to take large chunks of a company off of your hands. If you want to sell 1% of a company, well, maybe you can find a few buyers for that. If you want to sell 10% of a company, the number of people that are out on the other side wanting to buy that is much fewer. And certainly, as is obvious, if you want to sell 20% plus of a company, there are likely to be very, very few buyers of a position of a stake of a company of that size. And if there are buyers out there, the chances are that they're likely to want to negotiate very, very hard on the price, and therefore you may be forced to sell these positions lower than the market price you have in your valuation. So it's not just a case of being illiquid, it's also a case of thinking about the allocation and the weight and positioning that a manager has, and how much they own in certain companies as well, and how easy it is for them to sell large parts of those companies. So that's really, in essence, a bit of the background as to what's gone on. I just wanted to use this section just to think about fund selection and look a little bit about some of the mistakes that people make, but also think about how we go about our fund research process. Now, clearly in the market, there is a huge amount of investment choice. I have been an advocate for years that there is way too many funds available in the market, and I think the industry wouldn't bat an eyelid if probably more than half of the funds available in the universe closed tomorrow. Would make all of our lives a huge amount easier. There is a huge amount of choice, and therefore it's important that we understand what those funds are trying to achieve. But of course, there is no one magic formula for outperformance. No one manager has ever found the secret recipe for outperforming in every single type of market environment. Neil Woodford, Anthony Bolton, Terry Smith, Richard Buxton, you name the managers that have had great reputations, they've all had significant periods of underperformance. Terry Smith, in launching his fund in 2010, has had a very strong market, behind him, it'll be very interesting to see how he performs in a sustained sell-off. So no one's got the magic formula for outperformance, and it's important that any investment that's made, it is understood before that is made, and therefore it's vital that you understand what you're buying, and that really comes down to understanding how the manager invests. And I like to think about this as giving yourself a frame of reference. What does good look like? When should they outperform? But also, just as importantly, when should they underperform? In our portfolios, we fully expect to have managers that are underperforming at any one point in time, because if we haven't got that, we haven't got diversification. So it's important we understand which managers should underperform at which point in time. You also need to understand what you're paying. Of course, fees are a vital part of any part of the research process today, and therefore understanding how expensive a fund is, where it fits into its peer group on the basis of cost, and also your thought process around can that manager outperform after those fees is absolutely vital. Now, what we see when we analyse the behaviour actually of a lot of professional fund investors, but also amateur fund investors, is that the average investor tends to buy and sell at precisely the wrong time. They tend to invest in funds when they're doing very, very well, and they tend to sell them when they're doing very, very badly. And you get this upside down position really, where they end up buying high and selling low, and continually make the same behavioural mistakes that are so well evidenced across so many academic papers and so on. And it takes a very strong investment process and a very, I think, strong understanding of your own behavioural characteristics and your behavioural weaknesses to try and mitigate some of these problems. And so it's a case of trying to identify what is your edge in finding well-managed funds, and crucially understanding how those managers invest. And moving on to that, we use I think a very simple framework to do that. This is not anything I would say particularly clever, and many people use similar frameworks to help them think about managers and understand managers. And so crucially, it's about understanding a manager's investment philosophy. How do they understand how their market is inefficient? It's actually very difficult for managers to articulate in most cases, and takes a lot of time to get them to articulate that in a way that is very clear. But crucially, it's about understanding their investment process. What do they do on a day-to-day basis? How do they position the fund? What risk constraints do they have on that? It would have been very clear putting Neil Woodford through this process on that investment process bit at the Woodford Equity Income Fund to understand the expectation of the skew towards smaller companies and illiquid companies here. But also you need to understand the people who's involved in that process, who are the key decision makers going through that. Now, in order to avoid the previous slide, the behavioural mistakes, we only use performance late in the process here. We use performance to verify our understanding of the other factors, that philosophy and that process there. And we use performance to make sure we understand the frame of reference we've given ourselves. So what does good look like? What does bad look like there? Because we're very, very comfortable having a manager that's underperforming when they should underperform, because we understand that in essence just about every manager has a style bias of some form or another, and market styles come and go. For example, as we record this webinar today, value investing is deeply out of favour. Therefore, it's perfectly understandable for me that my value managers are underperforming, and growth is in favour, and therefore it's I would like to see my growth managers outperforming. So a frame of reference, an understanding of style, of philosophy, of process is absolutely key. And if you can walk through your managers that you invest in and understand and articulate under each of these headings what your manager does and crucially why you own them, then I think you're in a very good starting place to have a robust investment process. But also, it's not just about making good decisions up front, it's about what you do with the ongoing monitoring side of things. Managers change, and for example, as we've seen with Woodford, is that things change, and the portfolio can change and can evolve and become less liquid or skew towards a certain area or a certain style. And therefore it's vital that you have an ongoing monitoring approach. Our approach is to have regular face-to-face meetings with managers. Clearly we do a huge amount of desk-based work, but we think there is a real advantage in being able to get in front of managers and talk to them, to read body language, for example, to pick over the losers in a portfolio. Obviously, any good marketing department will only want to tell you about the stocks that have done phenomenally well. We're, in many respects, far more interested in talking about what's done badly, because that gives us a real insight into how a manager thinks and how they behave, particularly when they're under pressure. So face-to-face meetings are a crucial part of what we do. Lots and lots of ongoing activity. We sit down as our team on a weekly basis to review the performance of every position that we have and our buy list. Lots of quantitative analysis to flush out issues and see how portfolios are evolving and changing, looking at liquidity and things like that. And also then the checks and balances within our business, the various committees to hold us to account, to make sure that we're analysing things in the right way, to make sure that we've not missed anything, and to really put the checks and balances in place on our investment process there, which works very well and gives us some kind of peer challenge, I think, to make sure that the work that we're doing is robust and we're doing what we say we're doing. But I think crucially to make sure that we're enacting our stated investment process in a consistent manner, and that consistency is key, because it hopefully stops you making irrational decisions over time, and hopefully enables you to spot problems before they become too big an issue. So just taking a step back to think about what does all this mean for, what does the Woodford issue mean for the investment industry? What does it mean for active management? What does it mean for fund selection, for investors, and all these things? Now, some of these questions are probably unanswerable at the moment because things are still evolving. But I think one of the key issues for me is that there seems to have been a little bit of a knee-jerk reaction, perhaps amongst the press there, that all active managers are bad. And I certainly don't think that's the case. I think there are some very high-quality active managers in the market. I equally think there are a lot of very poor investment actively managed funds in the market. And as I said right at the beginning, I'd be very comfortable if many of those were closed there. But I don't think the issues with Neil Woodford point to a systemic problem in the active management industry. There is not a systemic issue around liquidity across hundreds and hundreds of funds there. I've been doing this investment research for 20 years, and this is the first case in my career where we've had a large, high-profile fund owned by many, many different types of investor that's had to suspend for liquidity reasons. So this is not a systemic issue, but it equally is important. It shouldn't mean we're complacent. There are still things we can learn from this, and perhaps really that points to the second point, which is a reminder about investing in illiquid assets. And illiquid assets are best suited to a closed-ended structure, an investment trust structure, or maybe another structure that certainly the IAs we're talking about, where we have an open-ended structure that has less frequent dealing periods away from daily dealing. I'll come back to that in a second. But certainly think about where you've got exposure to illiquid assets. That might be physical commercial property, it might be smaller companies, it might be high yield bonds. You need to think about the structures that are most suited to use those. If you're invested, if you use an MPS provider, if you accept that illiquid assets are not well suited to open-ended structures, it goes without saying you really should be using an MPS provider that is whole of market, that has the ability to use investment trusts as well as open-ended funds. I think that's absolutely key. It's an important part of the structure we have here at AJ Bell, is the ability to use investment trusts in our MPS proposition, and we do use a couple of trusts currently to access certain asset classes. So I think that whole of market position is vital, and probably has become more important as the lessons from the Woodford situation are digested. Now, the FCA has actually been doing a big study into liquidity over the last 6 to 12 months. Interestingly, it was mainly focused around commercial property and looking to take on board some of the issues that have come up with commercial property post the Brexit referendum in 2016, when the property funds had to suspend. And they weren't really focused on open-ended equity funds, interestingly. Now, we did actually feed back into this review, and in fact, in January, we fed back, so long before the Woodford situation, we fed back to the FCA saying that we think they should broaden their scope away from just thinking about property and other very illiquid assets, because we saw liquidity issues in what may be perceived as more mainstream assets there. So we mentioned high yield bonds and smaller companies and so on. And so it's an issue we certainly have been well aware of for a number of months, and have been feeding back to the FCA on this point. We fully expect, I fully expect the FCA to be having a much more detailed look at liquidity now, and I wouldn't be at all surprised if we have a fresh review of the rules around liquidity and open-ended funds in terms of how that is communicated to investors, particularly around smaller companies' funds. Now, the final point on here, and one I think really the industry hasn't thought about enough over the last few years, is this suitability of daily dealing. Just about every fund that you'll see, every open-ended fund that you'll see, offers daily dealing. Now, it offers daily dealing whether it's appropriate for the underlying assets or not. And so if we have a mismatch between the asset you're trying to sell and the dealing period that you offer to your investors, then you are simply asking for trouble. And that is in essence what's happened with Woodford, and could easily happen with other investments. So if you're offering daily dealing on assets that cannot be traded on a daily basis, then I think the industry needs to ask itself some questions. The problem the industry has is there is absolutely no first mover advantage in being the first, let's say property fund to go back to, say, monthly dealing. All of the mainstream property funds today offer daily dealing. Be fairly certain that if one of them said, we're going to go to monthly dealing, a lot of investors would redeem that position and look at those other funds that offer daily dealing. So there's no first mover advantage in this, and I think the industry and as a whole, fund managers, advisors, the regulator, all participants really need to think long and hard about the suitability of daily dealing, and actually accept probably now that this mismatch has the potential to cause problems, and particularly if we enter more volatile market conditions where people are looking to sell more assets quickly and more readily, that daily dealing may not be the most appropriate structure. So I think we'll watch this space on this. If my views are pretty strong on this and pretty clear, and we certainly talk a lot in the press in recent weeks about the suitability of daily dealing. So something that's important to us there. So that's really all I wanted to cover in this short update. We've run through some of the issues we've seen with Woodford. We've also run through the importance of having a robust investment approach, and I've given you hopefully a few ideas about how you can think about that in your own investment research approach, and looked at the broader, what does this mean for the industry? That's very much a moving feast. I think there are still plenty of questions out there that don't have answers, but we will be writing lots about this. So do keep an eye out for some articles on these topics, and also we'll continue to be very vocal in the press where we think there is a strong case for trying to shape the way the industry tackles these problems going forward. As I said at the start, if you have any questions on what we've covered or anything else about our investment process, our NPS solutions, our fund solutions, please do get in touch. We'd be delighted to talk to you, and I'll be very happy to discuss any of these points with you. Thank you very much for listening, and look forward to talking to you again soon.